Welcome to Retirement GPS, navigated by Zenergy, your roadmap to a secure and confident retirement. Each week, we explore strategies, stories, and planning frameworks designed to help you navigate the complexities of life after work. From tax planning to investments, income strategies to risk management, our goal is to give you the clarity and confidence you need to make informed decisions. But retirement isn't just about the numbers. It's also about lifestyle, purpose, and peace of mind. We're here to guide you through both the financial details and the personal dimensions of this next chapter. Let's chart today's course.
Welcome to the Retirement GPS podcast. I'm your host, Ryan Zaharchek, certified financial planner and founder of Zenergy Retirement Planning.
I am Zane Belsack, associate planner here at Zenergy. Today we're diving into one of the most important parts of the GPS framework, tax planning.
Because remember, it's not about what you make, it's about what you keep. We've seen so many people do a great job building their nest eggs, only to give far too much back in taxes simply because they didn't have a plan, or worse, they had the wrong plan.
And I think people assume that retirement essentially means lower taxes, but that's not always the case.
Yeah, you're exactly right. Let me start by sharing a story about a couple that we've actually worked with. The couple's name is Rudy and Joan. Rudy retired at age 67, Joan at 65. They had saved well, really done all the things they were supposed to do with most of their money in a 401k, and then a paid off home, so a lot of home equity. They had a small pension, and they were ready to start collecting Social Security. And they expected, like most, that when they entered retirement, they will be in a much lower tax bracket than while they were working. But when we put all the numbers together, they were actually paying more. They were in a higher tax bracket. The worst part was that almost all of their assets that they had to tap into were in a pre-tax 401k. So every time they needed to buy a car or fix their roof, take a big trip, or pay for a wedding for a child, they paid a hefty tax bill, and it occasionally pushed them into much higher tax brackets. They were stuck. Their tax liability was completely out of their control. And the problem really came in when they hit required minimum distributions, which start at age 73. They needed to draw big distributions from their pre-tax accounts that they really didn't meet.
And that's something I've seen pretty often in meetings. Is that a common issue that people have?
It's not unusual at all. Retirement income comes from different sources. And if most of your savings is in tax-deferred accounts, which, by the way, not a mistake. We all learned as a child, or maybe not as a child, but as a young adult, put your money into your 401k, save for your future, and we think we're doing the right things by doing it. But when all of our money goes into a pre-tax 401k, every withdrawal down the line becomes fully taxable, and you could fall into the same problem that Rudy and Joan have. That's why planning your tax strategy in retirement is just as important as picking the right investments. And in my experience, people feel strongly, really in their bones, about reducing taxes. It's visceral when I talk to people. They almost get angry when they talk about having to pay taxes. And I believe that most people are happier when we save them $1,000 in taxes than if we made them $10,000 in an investment. And I know that sounds crazy and very illogical, but I know there's a lot of people out there in our podcast land nodding their head and saying, yeah, that's me. I'd much rather save $1,000 in taxes. Sounds crazy, but it's true. So let's start by learning a little bit about how we can solve this problem. The first thing that we're going to talk about is tax brackets. Think of the tax code like a set of buckets that are lined up on a table. Each bucket can hold a certain amount of income, and each bucket has its own tax rate. The first fill is at 10%, the next at 12%, and so on. And the trick is to manage how much you pour into each bucket without spilling over into the next one unnecessarily.
So it's really not about avoiding taxes altogether. It's about staying intentional with how much income lands in each bucket.
Very true. We use tax diversification to help with bracket management. And it's one of the most powerful levers retirees have. For example, if you need extra income for a home project, you might take some from a Roth or a brokerage account instead of from your IRA to avoid overfilling a bucket.
Would you mind explaining tax diversification for the listeners?
Just like investment diversification, spreading out your risk, tax diversification spreads out your tax exposure. There are three main buckets that we talk about. The first one is taxable accounts. Now, a taxable account is pretty much the things that you know and use every day. Your checking account, your savings account, CDs, brokerage accounts. You pay the taxes along the way. So if you've ever gotten a 1099 from your bank telling you that you made $7 in interest last year, hopefully more than that, but in a lot of cases it's $7, you know you're going to pay taxes on that $7, right? Because you're taxed each year. Same thing in your brokerage account, interest, dividends, capital gains. Those are all taxable in the years that they're recognized. Then we have tax deferred accounts. So those are your IRAs and your 401ks. When you put money into those accounts, you get a tax break up front. Then you defer taxes, right? So we put in $5,000 into our IRA. That $5,000 grows to $50,000 over a 30 or 40 year period if we're lucky, which is great. But the problem is now we got to pay taxes on all $50,000 in principal. Every dime that is in that account is taxable when we pull it out. And it's taxed as ordinary income. It's not taxed as gains, which is great because we get this great benefit of getting a tax break up front and deferring taxes, but a huge liability later. And then lastly, our favorite type of accounts are tax-free accounts. With a tax-free account, such as a Roth IRA or a Roth 401k, we put our money in and we don't get a tax break up front, which actually ticks people off when we tell them about it, because the first thing they say is, well, what do you mean I don't get a tax break up front? And even for some higher income earners, the Roth IRA probably still makes sense, even though you're paying a higher tax rate up front. The great thing about your Roth IRA or Roth 401k contributions and how they behave over time is once you pay the taxes on the principal up front, you never pay a dime of tax on that account again. So in the same example, if I put $5,000 into my Roth IRA, I have to pay tax on that $5,000 as if it's earned income to me, but it grows to $50,000, and now I take the $50,000 out, and the $5,000 I prepaid the tax on, and the $45,000 is completely tax-free. I do not have a dime of tax, and that $50,000 I can take at any time without even having it go on my 1040 on my tax return.
So what you're saying is, and really it seems like the benefit of all this is flexibility, being able to choose really where to draw from depending on the year.
Yeah, exactly. The flexibility is key in financial planning. Having flexibility, having choice. It's one of the reasons we don't like to lock ourselves into investments where we're required to stay in those investments for long periods of time. If tax laws changes, if your incomes fluctuate, you can adjust, and that's really the key. That flexibility is the difference from being forced into a higher tax situation and completely losing control of what you pay in taxes to you retaining complete control over your bracket and thus your tax liability.
And you touched on this previously, but I wanted to dive deeper into Roth conversions. What can people really do about this, and what do you think are some strategies to diversify their taxes?
Saving properly from the beginning is really important, and putting money into IRAs, specifically Roth IRAs, putting money into your 401k, and if you have the option, a Roth 401k. And I can tell you 10 years ago, most employers didn't offer a Roth 401k, so it wasn't even a choice. If you're in your 30s, 40s, 50s, or 60s, you kind of didn't even have as much of the options that are available today. If you're a younger person listening today, start with tax diversification from the beginning. It makes it a lot easier later. But unfortunately, most of the people that come into our office, they're already past that point. They've already gotten to the point where they've saved a lot of money in pre-tax accounts. Certainly not a problem. Again, you did the right thing with the options available to you, but we do have a problem, which is your tax liability and your tax situation. Good problem to have, but a problem nonetheless. By the time we get to them, it's not too late, but we have to make some radical moves in order to fix their tax diversification problem. They already have these large pre-tax accounts. So in this case, we look to do strategies like a Roth conversion. Here, you're simply moving money from a tax deferred account, like an IRA, to a Roth IRA. You pay the taxes today, but everything in the Roth grows and comes out tax-free later, as we discussed.
And can you explain why would someone want to actually accelerate these taxes?
Yeah, it's a great question. We've all learned, whether it be in reading books or talking to friends or even just in movies about anything related to finance, that we always want to defer our taxes, right? Pay the taxes down the road, down the road, down the road. Well, the truth is that's not always the case. Think of it like paying the toll on a bridge. You can either pay now when the toll is cheaper, Or you can wait until later and pay the toll when it's doubled, right? So you're paying that toll regardless. Either way, you have to cross the bridge and you pay the toll. But that toll is not going away. Most retirees would much rather pay while rates are historically low, and that way they can travel tax-free for the rest of the journey. We want to make sure that we're not converting everything all at once unless it's advisable to do so. We can convert as little or as much as we want. We control that. We control the tax bracket that we're converting in. We use bracket management to convert just enough that we can fill the lower buckets without spilling over into the next one that is much, much higher. So over time, this really dramatically reduces lifetime taxes and minimizes required distributions later. The strategy can be complicated, so be careful when you're going out. Anytime you proactively increase your income, you may inadvertently be triggering other things, such as higher Social Security taxes or higher IRMAs, which is the premium that you pay on your Medicare benefits if you are collecting Medicare. However, when done right, it's probably the most powerful tool that we have in our arsenal.
So once retirement begins, and I guess pretending I'm a retiree and want to draw income, how exactly do I decide which accounts to tap first?
Yeah, it's a great question, and it's tricky. It actually took us a little time, even here at Zinergy, after we started, to come up with a good sequence of withdrawals, and that's what we call it, withdrawal sequencing. The general rule of thumb is, first you want to start with taxable investment accounts, okay? Then we move to tax-deferred accounts, and then we will save our Roth accounts for last or as late as possible. But I want to caution you, that rule of thumb doesn't actually apply to a lot of the people that we work with because it's really not a one-size-fit-all strategy. Everyone is different and has a different situation. So sometimes we intentionally draw from IRAs earlier so that we can lower future required distributions. We also know that we're in a historically low tax environment. Taxes today, income tax brackets are lower and definitely on the low end of where they've been throughout history. Drawing from taxable accounts now may make sense, especially if your brackets are lower. Sometimes we use Roth withdrawals in years when income spikes to avoid higher brackets. It's about sequencing withdrawals to match both your tax situation but also your goals. The important point to remember is that we're not trying to minimize your tax burden in any one year, but over your lifetime. That's the difference between what we do and what an accountant will do, because accountant will typically look at where are you this year and how can we lower your tax burden this year. But a lot of times you'll lower your tax burden this year, but sacrifice your future. The Roth conversion is a perfect example of that. Why would we want to pay taxes this year when we don't have to? It's because we're lowering them over our entire lifetime. When you reframe your time horizon to a much longer period, you're now playing the game of chess as opposed to checkers, right? We're not worried about just do this to lower this. We're looking at it over the long period of time and how that lever affects all these other variables down the line.
It's about designing the right strategy over a lifetime, really framed over your goals.
And we only just scratched the surface on this podcast. So we typically talk to our members about strategies such as backdoor Roth contribution, donor advised funds, tax loss harvesting, net unrealized appreciation, and a whole host of other great tax strategies that can reduce your tax liability over time. Unfortunately, a little bit outside of the scope and the time that we have in this podcast. But just understand, less taxes paid means more in your pocket to enjoy your retirement.
And that's always a great way to think about taxes. I understand there's a lot of moving parts on this. So to recap, we covered bracket management, tax diversification, Roth conversions, and withdrawal sequencing. 4 strategies that, when combined, can make a huge impact on retirement.
Because remember, it's not about what you make, but it is about what you keep.
And the first step is simply just awareness, knowing what brackets you're in, what accounts you have, and what levers you can actually pull.
And we put together some resources to help you get started. We'll touch on these topics in future episodes, so we'll do a whole episode on Roth conversion and donor advised funds in the future due to their importance. But feel free to go to the show notes and take a look at the information that we have on there, because that'll really help clarify some of these tax strategies for your situation. So here we are. Let's talk about some action steps that we can take right now. First and foremost, make sure that you're subscribing to our Retirement GPS podcast. We don't want you to miss another episode. Give us 5 stars if you like what you hear. Follow us on Instagram, Facebook, and LinkedIn at Synergy Retirement for weekly tips and strategies, because we're going to dish out little nuggets to make sure that you're staying on top of your situation. Check the tools in the show notes, a free tax bracket chart to allow you to see where you stand today and what's the right fit for you. Until next time, stay intentional and, happy planning. Enjoy it.
Thank you for listening to Retirement GPS, navigated by Synergy. To explore today's topic further, visit our blog mile markers at synergyretirement.com/blog, where we offer detailed strategies, examples, and downloadable tools to support your retirement journey. Follow us on LinkedIn, Instagram, and Facebook at Synergy Retirement Planning for weekly insights, checklists, and planning reminders. If you found this episode helpful, please subscribe, leave a 5-star review, and share it with someone planning for their future. Until next time, keep navigating toward a confident retirement. This podcast is for informational purposes only and is not intended as investment, legal, or tax advice. Listeners should consult their own financial, tax, and legal advisors before making any decisions. Synergy Retirement Planning is a registered investment advisor located in Red Bank, New Jersey.